What if I told you the most explosive capital cycle since the railway boom isn't in oil or real estate, but in silicon, and that 6 U.S. tech titans now steer more AI spending than the Pentagon devotes to weapons? Before we dive in, pour that coffee. Today's story isn't about funny chatbots. It's about control, how nations weaponize neural nets the way they once hoarded bullion, and how that arms race could jack your mortgage rate, vaporize entry-level careers, and redraw the geopolitical chessboard. Let's begin. Flashback. 1956. Dartmouth coins. Artificial intelligence. 2012. GPUs conquer ImageNet. 2022. ChatGPT clocks 100 million users in 8 weeks. Now in 2025, data centers are slated to require $6.7 trillion in CapEx by 2030, meaning AI is already eating a double-digit share of global infrastructure investment. CapEx is the tell. According to Del Oro, global data center investment surged 51% year-on-year in 2024 to $455 billion. Nvidia alone captures a huge slice of that spend. Bundle Apple, Nvidia, Microsoft, Alphabet, Amazon, and Meta, the so-called Big Six. Their combined R&D outlays now top $300 billion annually, about 13% of their revenues, versus 9% a decade ago. Victorian railways soaked up half of Britain's steel. Post-war highways consumed 12% of U.S. GDP. 21st century AI consumes electricity, land, copper, and attention. This isn't a tech upgrade, it's an industrial pivot. Artificial intelligence needs a lot of electricity to grow, and that demand is booming. In North America, the amount of data center power being built has exploded from 457 megawatts in 2020 to about 6,350 megawatts by the end of 2024. That's more than 12 times bigger. At the same time, there's hardly any empty space left in the main data center markets. Vacancy rates have dropped to just 1.9%. In October 2018, the U.S. Commerce Department blacklisted Fujian Jinhua Integrated Circuit, cutting off a state-backed DRAM maker from U.S. suppliers on national security grounds. The EU AI Act followed in February 2025, outlawing unacceptable risk systems and slapping transparency rules on foundation models. A clear sign that Brussels isn't refereeing, it's annexing the AI stack. Winners first. Nvidia, whose GPUs alone account for a massive share of AI CapEx. Utilities with 20-year offtake deals. Power is the new rack space. Copper miners, with China's AI build-out set to soak up 12% of global refined output by 2027. Sovereigns that subsidize fabs via the CHIPS Act, IPCEI, and Japan's $30 billion TSMC carrot. So who are the losers? White-collar trainees. Cisco's 2024 ICT survey warns that 92% of roles will be highly or moderately transformed. Anthropic's Dario Amodei predicts half of entry-level jobs could vanish within 5 years. Algos don't need dental. On factory floors, robots outnumber interns. China installed 276,000 industrial units in 2023, 51% of global volume, turning labor arbitrage into no-cost automation. Here's the macro twist. AI promises productivity yet pulverizes the tax base that funds social safety nets. Rome's grain dole collapsed when conquest stalled. Modern welfare leans on payrolls now at risk of automation. Fiscal gaps widen just as CapEx sucks liquidity. Markets see the tension. Bloomberg tallies $389 billion in Big Six free cash flow, up 263% in a decade. Yet almost all of it is pre-spent on GPUs and grid hookups. Earnings look sturdy until inference costs collapse again. So what's a contrarian to do? Long picks and shovels, transformer OEMs, high-amp switchgear, copper miners. Short-bloated SaaS multiples, code heavy. Pair trade grids, own utilities with AI offtakes. Our institutions certify risk. Like it's 1999, Basel runs on credit loss models, not compute shortages. When regulators ignore power density, they misprice bank balance sheets loaded with utility debt. Complexity rises, oversight drifts. Late Imperial Britain privatized rails to plug budget holes. 1990s Russia auctioned oil monopolies. 21st century America sells treasury-backed chips to subsidize fabs. Empires monetize control when stretched. The invoice always arrives by decade end. China's open source surge is not generosity, it's a sanctions shield. If the West throttles silicon, Beijing can still iterate code. Conversely, Washington's export choke points raise the dollar premium on every wafer, nudging allies to fork supply chains. The mortgage link? It's simple. AI spending drains bank liquidity, pushing banks to buy bonds. The Fed offsets this with quantitative tightening, and bond durations swing wildly. A 1 percentage point jump in the 10-year yield can lift 30-year fixed mortgage rates by about 3/4 of a point. Suddenly, your suburban dream home is being repriced by a server farm in Phoenix. Investor radar. Track CapEx to cash flow ratios. When the Big Six average breaks 1.2, history says margins peak 12 months later. Same pattern flagged the 2015 cloud pause and the 2000 fiber bust. If you're 25 and worried the bots will eat your resume, learn power electronics, not Python. If you run capital, remember optionality beats forecast. Build positions that win. When costs have and when policy bumbles. History moves in cycles, but the bold don't just brace for revolution. They monetize its aftershocks. Question mainstream narratives, run your own spreadsheets, walk the factory floor, and always keep an eye on CapEx. Because when the shovels run out, the real rush begins. If this served you, hit subscribe, drop a comment. Which AI edge excites or terrifies you the most? History rhymes. Power rebrands. Stay inquisitive.